You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
All right, everybody, that music means it is time once again for a very special episode of Options Playbook Radio, the episode where you folks take the reins, your questions, your comments, your pearls of wisdom. My name is Mark Longo from theoptionsinsider.com, as well as, of course, from the ever insightful, at least we hope so, Options Insider Radio Network, coming at you pretty much every day throughout the trading week. Usually a couple of shows hitting you a day, including your double dose of education Wednesday. You got your OPR as well as your options boot camp. So a lot of educational content coming your way. So if you like what you hear at this show, any of the shows we do here on the network, keep rating and reviewing it on your platform of choice. It really does help the avalanche of new listeners that we have seen discovering A, the world of options, and B, as a corollary, discovering the network. It helps them find a path to our door. It's more important than ever in these turbulent times out there to have a reliable source of information, particularly for this audience, the educational audience. So if you like what you hear, keep rating and reviewing. It really does help new folks discover the content. Of course, keep those questions coming too. We do love to hear from all of you guys and gals out there. And let's see who we're hearing from today. I think you know who we're hearing from because it's his show, Mr. Brian Overby, a.k.a. the Options Guy, a.k.a. the Senior Options Analyst over there at Ally Invest. Mr. Overby, welcome back to your own program, sir.
All right. It's always great to be back. And I always appreciate you willing to come on in and help me host and answer some listener questions. These are some of my favorite episodes to do. So when we do it, I always like to huddle up and answer listener questions.
It's time to huddle up and answer questions about your favorite options plays. Submit your questions via twitter.com/options, facebook.com/theoptionsinsider, or questions at theoptionsinsider.com.
All right, everybody, let's do it. Let's dive in. Mr. Brian, you're a popular guy these days. A lot of folks angling to get at you here on the show. Let's see how many we could squeeze in to this huddle. Let's start off with a fun one, an easy one. This one comes, or maybe not. Maybe it's a hard one, I guess, if you think about it a little bit. This one comes from Nicholas. He just wants to know very simply, Brian, what's your favorite episode of OPR? So there you go. Maybe it's deceptively simple, Brian. What is your favorite?
Well, I love listener questions overall, but I think that that's a cop-out. But those are usually some of my favorite episodes. But I think if I were to highlight some episodes that I enjoyed doing the most is when we got creative. Back in the day, I look back and we did airline doppelganger is one of my favorite ones. We came up with a creative trade that wasn't actually even in the options playbook. We did an RBG butterfly. Those ones where we've came up with some of these creative names and some creative actual strategies that kind of broke the mold, I think would be some of my favorite ones to do. And then even a couple things on long straddles. A lot of times, a lot of people will focus on just selling premium, but from time to time, sometimes buying premium is a good thing. So talk about how I'd set up a straddle or a strangle. We did some of them in the airlines, in particular around Boeing and all the news that was on Boeing prior to the pandemic and then even after the pandemic. So a lot of those positions that have the odd names where we got creative on them, those are always the fun ones for me overall.
I'm going to cheat. I'm going to vote as well, Brian. And I'm going to go back to, it has to be one of our many episode spectaculars that we did, the 100th to all the way through, all the ones we've done. We did one of the early ones where we had a series of special guests. Do you remember that? And we did a bunch of episodes around this. So it was kind of like, it's kind of cheating because it's kind of like 6 episodes in one, really. But it was an awesome episode. It featured kind of a who's who of the options world, and it was certainly kind of fun. So if you're new to the program, I know a lot of you are, and then go check out the archives, especially some of our round episode spectaculars. Those get pretty fun and pretty wild and pretty creative. So I'm going to vote for those. All right, next up, we've got Vivek. Vivek wants to know, hello, Brian. I recently discovered the Options Playbook Radio, and I'm enjoying every minute of the podcast episode. So, Brian, he's one of the new legions who are discovering OPR all the time. He says, I was listening to this episode the other day, episode 349, Forget GameStop. It's time for a skip strike butterfly in Google. Yes, I recall that episode. He says, I had always envisioned the skip strike butterfly to be centered at where the underlying is trading. Opening a call skip strike butterfly above the market for a credit looks really interesting. When is this done? When this is done, at the same time, how about opening a put skip strike butterfly below the market for a credit? Kind of like an iron condor, but made up of skip strike butterflies instead of credit spreads. Do you think this is a good idea? Thanks, Vivek. Well, Brian, I can tell you like this one because he's going after one of your favorite strategies, the skip strike fly. He wants to take advantage of some of the crazy skews we've seen out there in a lot of names, including GameStop out there, and perhaps put on his own variation of the skip strike fly, perhaps the skip strike iron condor. Brian, what do you think of that?
I love the question overall because I have looked at a skip strike. Iron condor. Talk about odd named strategies, right? We're going to have to come up with a new one for this. The skip condor. I'm not quite sure, but overall, in the Google situation, and actually last week when we were talking about Tesla, we looked at skip strike butterflies as an alternative to doing a short spread. And so that kind of goes with this theme of doing it as an iron condor. Now, my only problem with doing it on a stock like Google or a stock like Tesla is I don't necessarily like to do a skip strike on the upside and on the downside in a very volatile stock. I'd rather pick a direction. I wouldn't mind doing it in a little less volatile stock or maybe in index, but here's the problem. When you're looking at it on the put side, a lot of times because of the way the skew is, it's hard to get it done for a decent credit. Especially in extremely volatile underlyings. Like I would say probably in Tesla would be a lot harder to do it than maybe in Google overall, just because there's a lot of skew in general. Well, it's died down a little bit, but in general, there's a lot of skews on the put side in Tesla. But with that said, I love the thinking. I love that the mind is working, that we opened up your mind to looking at these type of trades. I do like a little bit more expensive underlyings, but maybe not quite as volatile. So if I were to do it the way that it's laid out, a skip strike butterfly on the call side out of the money and a skip strike butterfly on the put side, I would want a little bit more tame underlying to do it on in general.
Yeah, that was going to be my thought as well. The second he sent this question is usually when you see these crazy skews, they're usually bid in one direction, right? You're not going to get the same bid for the puts versus the call. These days, it's all calls all the time, maybe a little bit less so, like you said, but still, it's hard to see a strong bid for both. If you want something like that, Vivek, you might actually have to go out to the commodities. That's where we start seeing more smile. That's what you're looking for here. You're looking for a smile type skew where both the puts and the calls are equally bid to the at-the-money vol. So you can find that now and then in the commodities. In the equity and index space, little bit more hard to find out there. But it's an interesting idea nonetheless. And again, I'm with Brian. I like when you folks are taking what we talk about here in the show and taking it to the next level, if you will. Speaking of things you like to talk about here on the show, Brian, we got a two for. Actually, before we do that, we got a live listener chiming in. I like this. He's going back to our first question we talked about here, which was your favorite episode, Brian. And he's voting for the election episode. Now, I'll give him a caveat. You were on that episode, Brian, but not technically an episode of Options Playbook Radio. So I don't know if it actually qualifies, but because he's right, that was an awesome episode. I'll give him bonus points, Brian. What do you think?
Yeah, without a doubt. Without a doubt. And at the end of that episode, we just mentioned a trade. Overall, I just kind of tossed one out there, but it was really weird because it came to fruition on the Monday after that episode. And I guess I could go there. We just talked about buying out of the money call options on the airlines, just in case the pandemic actually, or just in case they came up with a vaccine. And it just so happened that on Monday they made announcements on a vaccine, and all the airline stocks jumped.
Yes, it doesn't seem like it was that long ago, that episode, but it was the election, of course. And S&P was around 3,300 when we were doing that show. So a 700 plus handles below where it is right now. So, how time and the market flies when you're having fun. But a good suggestion there, Mr. Unlimited. Let's go on now. Question from Melvin. Actually kind of got a couple related questions here, Brian, so we'll loop them together. First is Melvin. He says, hey, guys, long time, first time. Well, we love you there, all the new listeners there, or in your case, longtime listener who's writing in for the first time. He says, I've heard Brian talk at length about the fig leaf strategy, but I'm still confused on one key concept. How does it work at the brokerage level? Since you're not really covered by the long in the money call, does the brokerage margin the short call as effectively a naked short call? Are they considered somewhat offsetting positions? Is that why Brian always says we should be so careful about letting the stock blow through our short call strike? I like the idea of the fig leaf, but it seems like it might be a bit of a position management nightmare. Love the show. Thanks for so much great knowledge. Then we have a similar related question here from Tilly. He or she wants to know, how does it work when you sell a covered call against a long in the money call position? Does the broker margin you like you wrote a traditional covered call? After all, you aren't really covered in your short call position. Do they margin you like a naked short call? Is it up to you to have to close or roll it before you get to the strike? So a couple of things to point out here, Brian. First off, it seems like your fig leaf terminology is permeating out to the masses. You have infected people, so ballyhoo to you for that, for getting that mediocre name out there in the minds of the masses. And then secondly, though, it seems like they are starting to discover the reason for the name, the fig leaf, which is you are partially covered. And that's one of the challenges of this strategy. So, Brian, what do you have to say here for Melvin and for Tilly, who have related questions about the mechanics of the fig leaf, sir?
All right. So we jokingly say that you're partially covered, but as far as the brokerage firm is concerned, as long as you are further out in time on the option contract that you own and you have the right to buy the stock at a lower price than the obligation to sell it, the brokerage firm is not going to hold out an additional margin requirement above and beyond basically the net debit that you're going to pay for that trade. Now, the reason why I always bill it as you're kind of covered, because first of all, it kind of makes the fig leaf name make sense. But if the stock did get to your short strike before the expiration of the front month or the short option contract, you really need to do something about it, because you have this long-term option that probably has some good amount of time premium in it, and you don't have the stock. And if you get assigned on that short-term option contract, you need to give them stock overall. So in that situation, you may not want to exercise your long-term option contract. You might need to sell it, actually buy the stock, and then offer that up as the 100 shares that you're obligated on a one-by-one fig leaf basis. So there isn't any additional margin when you first put on the trade, but you don't want to be asleep as the expiration of the near-term option contract happens. Because if you wake up and you're assigned and you totally forgot about the trade overall, you're going to have to do something. And your phone's probably going to be ringing from your brokerage firm trying to decide what exactly do you want to do on this position. So it's a nightmare if you're doing, let's put it this way. If you are a person that wants to set it and forget it, this is not the trade for you overall, but that's usually true about options. Now, the one trade where it is kind of a set it and forget it is a covered call position. You put that position on, and a month from now, the stock goes up and it gets called away. They just take your stock. If it goes down, you still own the stock. You might have some risk, but that risk is coming from the stock. The option isn't really creating that risk. It's the stock ownership. So a more set it and forget it strategy is the covered call position. The fig leaf offers up a lot of neat scenarios, not to mention the fact that you're actually limiting your risk by buying a surrogate for the stock instead of it. But you want to make sure if that stock gets to that strike price, you have an alert and you do something at that point in time. It could be as simple as you just close the position. Overall, you should be profitable on it if it reached your short strike before that expiration date. So you just close it, go out and be done with it, and go look for another fig leaf to do, another underlying to do a fig leaf on. Easy for me to say.
Yeah, the fig leaf has a lot of advantages: capital efficiency, lower risk, like Brian said. One of the drawbacks is a little bit higher maintenance there. So if that's not for you, if you like, as Brian said, to set it and forget it, covered call is kind of like the definition of the set it and forget it option strategy. That's why so many advisors and asset managers who are otherwise busy dealing with their clients, they'll do a monthly or a quarterly covered call. They set it and forget it, move on to the next thing. So that's what you want. You want lower maintenance, lower investment from a personal perspective in a trade. Covered call may be for you. But if you want all the benefits we talked about a legion of times here on the show that the fig leaf brings to the table, you have to work for it a little bit. So be prepared for that. All right, next up, we've got BLS0603 wants to know, do you know of any brokers that allow for complex options trading without a margin account? I guess that depends what you mean by complex. I think we all saw this very recently with all the crackdown against the meme stock trading, right? A lot of different brokers had different definitions of what complex options trading really was. But, you look at a lot of people trade options in an IRA, and that's not a margin account. And yet you could do a lot of things that you could consider quote unquote complex, like multi-leg spreads and everything else like that, and other more advanced strategies. So I guess it really depends what you mean by complex. Brian, what are your thoughts here for Mr. or Mrs. BLS0603 and the notion of trading options, or I should say complex options, without a margin account, sir?
The better way to ask the question is, can you do complex options in a cash account? Because that's what IRA accounts are. They don't have the margin feature attached to it. And there's really one general rule of thumb. If you are doing it in a cash account, most of the time the brokers won't allow you to be naked risk. So I can't sell a call naked. I can't sell a put naked if I don't have the cash to actually buy the stock. But most brokers in a cash account will allow you to do fairly complex trades as long as the risk is defined and you have the ability to cover the worst case scenario as far as the profit and loss graph is concerned on that strategy. So I'm going to say yes, because I think of doing a short call spread or a short put spread or an iron condor as a complex option trading strategy. And most brokers would allow you to do that in a cash account, or i.e. an account without the margin feature.
Yeah, there's a ton of options trading that goes up every day in an IRA, so you don't need the margin to trade options. It adds an extra layer to it, obviously. But, of course, IRAs have the tax advantages, so it depends what you're looking for out there, Mr. and Mrs. BLS. All right, let's go to this one here. Let's go to this one from Big Fig. I kind of like this one. I like the handle, Big Fig. He or she's saying, I understand that options can go to zero more likely than a stock can due to complications like the expiration date. So I get that I can lose my entire investment. But are there any scenarios where I could lose more than my entire investment? This is a common misperception out there, Brian, people have when they come to options. A lot of them particularly these days, right? What are they doing? They're buying calls. They're buying options typically. So that's a good limited risk approach if it's done intelligently, buying a ton of upside on Tesla and hoping for the best. Maybe not the most intelligent use case for buying options, but if you're out there buying options, at the very least, usually that your risk is limited to what you're paying for that option. Now, people will usually take that knowledge and then extrapolate it to places where it doesn't actually apply. Like a lot of times when I see this is when people get into things. Typically, it's like ratio spreads where they're naked short units in one direction or other. Let's say, listeners, you buy instead of buying a traditional call in Tesla, you, God forbid, come out and buy, let's say, an at-the-money call, and you sell 10% out of the money calls. Now you're 1 by 3 on that spread, right? So you still are probably ending up net buying it. You're still paying a premium for that spread. But guess what happens if Tesla blows 20% in the next couple of weeks, right? You're going to blow through that short strike. And you're going to be losing a lot more than what you spent on that trade. So just because you spent money on it, just because it's a debit trade, if there are naked short units in one direction, you can end up losing a lot more than you spent on the actual trade. Brian, is that the most frequent scenario you encounter as well with this type of question? People usually having some sort of net short unit leg that they didn't know about, didn't understand. That's what comes back to bite them. Even if they spent money, they paid a debit for the spread.
All right. There's a couple of other scenarios, and it has to deal with, once again, expiration. And like we just talked about on the fig leaf strategy, you got to be awake at expiration, even on long call positions. So you're talking big fig, we're talking about just a flat out buy of a call option. I have had a situation where we've gone into expiration. The option contract is 10 cents in the money approximately, and the person doesn't close out the trade. Automatically, that person gets exercised. They end up buying the stock just because they had the cash in the account. Most of the time, brokers would close you out if you didn't have it, and then find out Monday morning the stock's down 50 cents overall. Those are scenarios where you could lose more than your entire investment. But once again, it's because you fell asleep. You could have closed it out, captured your dime, not worried about it. Many other things that could have happened. But if you have option positions on one day of the month or week, that expiration date, you want to see what's going on with your option contract. Now, that's a very rare scenario, but it all has to do with exercise on the assignment. All brokers want you to make a decision as to what do you want the stock? Do you want to close out the trade? What do you want to do? And if not, they have to basically guess. So they have rules in place to say, if this is 1 cent in the money, we'll exercise for you. If you have the cash to buy the underlying stock, we're going to buy it for you. Those type of things. So that's one scenario that comes to mind that has actually happened with some of the clients at Ally Invest before.
There you go. So there are a number of different scenarios this could happen. They're kind of aberrant. They're not usual. The most common, like I said, is where you have those sort of naked legs, but there are those weird off scenarios too around expiration or big events like earnings. You could see weird things like this happen. So don't just fall asleep and think because you spent money on a trade, aka a debit, that you're safe. That's not the case, particularly if you have multiple legs to it and you are what we call net short units at the end of the day. That's where a lot of this can come back to bite you. These kind of questions are always strange to me, Brian, because you don't know the exact scenario. We got one here from Angry Manila. They want to know, I tried to close a short put on USO. I entered a buy to close for 10 contracts at the asking price. The order would not fill. I tried several times. There were definitely more than 10 contracts available in the order book. Any idea why it would not fill? Well, there's a lot to be unpacked here, Brian. He seems savvy enough to at least be able to check the order book and know that there is size available. That's usually the first thing I would tell somebody is like, hey, what are you looking at? What are you trying to trade? Is it an unreasonable amount? His size also isn't unreasonable here. It's just a 10 lot. But still, there's a lot of things that go on here, Brian. So these questions are always difficult to answer specifically without a lot more detail from the question. But I'm sure you get variations on this theme all the time, Brian, over there at Ally. Why didn't I get filled for XYZ reason? What are some of the more common scenarios why people, even in this kind of scenario where he's trying to lift an offer, may not get filled, sir?
That's a real tough one because you really need to know where did the order go, what was the market on that order what was the underlying that you're trading. USO is what we're trading, so that's a fairly liquid underlying. I find it to be very odd, and without looking into the detail, I really don't have a great answer for it. If you're trying to fill on the ask, and the ask is there and it's hanging there, I really don't see why you wouldn't get filled on an underlying like the USO. If we were trading consolidated lint that trades once a month by appointment, it'd be a little bit different. But USO is a very liquid underlying. I don't have a good answer. I don't even really have an idea why it did not fill. I mean, was the market open?
Yeah.
I mean, you get some of those weird.
He tried
scenarios.
to do it at 6 p.m. Central. Why couldn't he get a fill?
Right.
I understand.
Right. I don't have a great answer for this question.
Yeah, it probably is something weird like that. Maybe the time was weird. Maybe it could be something with the nuances and mechanics of the order. Maybe he didn't hit buy to close when he was supposed to, or vice versa. Maybe he already had an outstanding order for this that he forgot, maybe a resting stop. He tried to put another order in on top of it, and his broker kicked it out because you already have it. There's a lot of different behind-the-scenes things that could be the reason. But if it's just like you described here, Angry Manila, if that's the offer and you're trying to lift it for a 10 lot, and there's more than 10 in the book, and you did everything right, you should be filled. So chances are there's probably something done on the user side that complicated something out there. So yeah, send us more details. We'll be happy to look a little bit deeper. It's kind of hard from this remote distance to diagnose everything. But in those scenarios, you should be filled. We were just talking about buying options, Brian, and some of the challenges therein. Let's wrap it up here with this question. I like this handle too, Junkosaurus. Good handles this episode. Junkosaurus wants to know, I think SPY will drop over the next month. So does it even matter what put I buy below today's price? If it goes down, they all go up in cost, right? So I can just sell the put for a gain, right? Brian, this type of question really has become more common, I would say, over the last 6 or so months, ever since we've seen this just onrush of new traders in the options market. A lot of them are, like Junkosaurus, focused on the buying premium end of the equation, which is interesting. Most of them are buying calls. Junkosaurus is buying a put, so he's a little bit different from that regard. But there is this mindset out there, Brian, that people are either ignorant of things like the Greeks, which could very well be the case, or also maybe it's willfully ignorant. They don't want to learn these things. They just, like Junkosaurus says, hey, things are going to drop. I can buy a put, any put really below the strike, and I should be good, Brian. I mean, what could possibly go wrong with that scenario, Brian? Any puts, just gobble them all up, right?
Well, it sounds like a loaded question to me, in that Junkosaurus probably had a situation where it didn't make money on a scenario where he bought an out-of-the-money put option. And the best thing that I can do here is, I'm not going to talk about volatility or anything else. There's a lot of little things that could happen. But if you just think about options in general, and you think of options as the probability that the underlying will finish in the money on expiration. That probability that it will actually finish 1 cent in the money, not necessarily that you'll make money, affects that option price. So I'm going to give you a real quick scenario. It's going to be a theoretical thing, and this is my best scenario for beginning option traders. All right. I have a 30-day put option. I'm going to be 5 points below the market. We're going to say the stock is at 70. We're going to buy the 65 put. We have 30 days remaining to expiration. All right. So 15 days go away. The stock goes down 2.5 points, right? So it made half the move in half the time. I ended up paying $1 for that option contract. What's the option contract trading for now? Guess what? It's still trading for $1. Approximately. This is all in theory overall. Why? Because the probabilities didn't change. You were looking for a 5-point move in 30 days. The underlying moved 2.5 points in 15 days. The probability, if everything stays the same, is still basically the exact same as it was when you put on the trade. So if you're buying specifically out of the money option contracts, be aware that you really need that underlying to get to the strike that you pick, or there's a chance that you could be right on your forecast, but it didn't move fast enough or it didn't move hard enough to make you profitable on your option trade. Now, There's a lot of other things that play into effect, but that has always been, in my 20 years of teaching, one of the most straightforward scenarios that you can put together when you're thinking about buying out of the money option contracts. And one of my most popular white paper series are the top 10 mistakes of beginning option traders. I'm going to emphasize beginning. And one of the number one mistake is starting by buying out of the money option contracts. Just because they don't quite understand that concept, how much the probability of the stock reaching the strike weighs into the actual price of the option contract. So long-winded, but I just love that little scenario because it so is true with out-of-the-money options. And then you throw in things like volatility and news and other things that can happen, and it gets a little bit more complex. So my recommendation, and when I teach basic option trading, I don't go straight to strategies. Usually my first or second session, I talk about the pricing and how options are priced much differently than stocks overall. And that's one of the scenarios that people can get their grasp on. They can understand, well, I get that. I was right, but it didn't make the move fast enough, and the probabilities didn't change of it reaching that strike price overall.
Yeah, it's a lot to unpack in that deceptively simple question, but you're right, Brian. People who buy premium typically don't understand the velocity that they need in order to make that trade pay off. You don't have to just be right within your time frame. You have to be right fairly quickly, or otherwise the scenario Brian played out there could play out for you. You have a little bit of a move instead of a lot of move, and you watch your option you bought erode to next to nothing. You could easily be stopped out if you're using stops before the move actually happens, if it doesn't happen fast enough. So you need not just a move within that time frame, but it has to be pretty early in that time frame. Otherwise, you can see that option erode, and of course, the more it erodes, the farther you have to go in terms of trying to make that back, and the more aggressively you have to move in order to make that option make sense for your portfolio. So these are things people forget when they're just willy-nilly buying and gobbling up options out of the money. Unfortunately, Brian, that music means we've come to the end of this huddle. People pull out this kind of stuff. Maybe we'll have to do more huddles here down the road. But before we go, Brian, if people want to join the next huddle, maybe they want to get at you directly in between episodes of OPR, where should they go? What should they do, sir?
Well, if you'd like to join in some of our huddle programs, you got to send a question in. You can send them directly to me at theoptionsguy@invest.ally.com. You can also follow me on Twitter. My handle is @BrianOverby. And want to say thanks for listening, and we'll be back at the same time, same place next week. Until then, may all the options you bought finish in the money, and all the ones you sold finish out.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.